what created the gold standard were the restrictions that having gold backing the currency created, so it really required fiscal responsibility. In 71, Nixon handed what that really happened in 71 was that Nixon handed over full control of inflation to the central banks, to the private banks. And what do banks know? They know debt and they know interest. But so you could say that it really it's been dying since 1913. But
Yeah.
no, we're not still on the gold standard as a government or as a country or around the world. But I personally am absolutely
Sure.
on
Yeah.
the gold and silver standard.
Yeah.
So a competing currency or just taking away the public's power, because that was a public power that if you had enough people that did it, then you have a run on the banks, etc. So they did own the gold. You're absolutely right about that, but it was more to the citizens. In 71, it was to the other governments, global governments, but 33, they had to take that control away from the citizens. I think it's going to be really interesting to see what happens when the central banks really come out with their digital currencies. Because when you look at the Bank for International Settlements money flower, there is a small space on there for private cryptocurrencies. But there's that actually larger space for commodity money, so gold and silver, and then all the rest is under the central bank's control. But so I think that they are going to, allow a certain amount of it, but I think it'll be very controlled and heavily taxed. And I don't think they're going to allow any competition to their money monopoly. But it'll be interesting to see. The battle has begun. Look, the very foundation of the fiat system, the government-based money system, is inflation, which guarantees loss of value over time. Even though nominally, you had a $20 bill 10 years ago, you got a $20 bill today, it's still a $20 bill. So nominally exact, but what it buys you. So, these guys are smart. They know the system is dying. And so, yeah, I definitely think that kicking the can has been going on since 1913. That's not actually something that's new.
Yeah.
But I think they know that we're at the end game because every currency, actually everything, has a life cycle. I'm definitely at a different point at 66 than I am at my granddaughter at 6 years old. And currencies are no different. And really, if you look at the monetary velocity chart, what you see is that it in the M2, so a little bit broader base of money, it peaked in 97. And so then they did financial engineering and they jury-rigged this and they jury-rigged that to create more money in the system, but it still did not increase the speed at which money changes hands. And, really good point. All they have left is money printing. And, I pay a lot of attention to the monetary velocity chart. And what I'm seeing is that it's declining again. We got a little teeny bump up. I said, we have to see, this has to be pervasive. And it has not been pervasive. It's the most current graph. I was just looking at it earlier today. It's declining again. So all of the rule changes, changing Reg D, which they did in 95, again, to create that velocity by allowing banks, you make a deposit into your account. And I think this is critical for people really to understand. You make a deposit into your account at a bank, they sweep those funds into sub-accounts. For the bank, they can then use that equity to borrow for their benefit and do anything they want to with it. But really importantly, that means they don't have to hold as much in reserve. Okay. Now, currently, there is another regime shift that just went to final on, I think, February 21st of this year, but they put it in place in March of last year, a change in Reg D, where savings deposits and money markets, which are considered sticky, in other words, you put the money in there and you're going to keep it in there for a long time, have been shifted into the same area as checkable deposits. So you write a check. So that again reduces the bank's requirement to hold reserves. But what does that really do to the money that you are holding in the bank thinking that it's safe?
Well,
right?
It makes it less safe. It's more leveraged out for sure.
Yeah, especially with everything that's happening with the banks with derivatives.
Mm-hmm.
And the tools that they've used to hide the value at risk. But your deposits aren't safe. Inflation and deflation, people think they're two different things, but they're really not. They're just the flip side of the same coin.
Mm-hmm.
And the only way that you can fight deflation is with inflation. And at the end of the day, when you look at what they're doing, whether we go to negative rates, which would really be hyper deflationary, right? You're going to go out and spend if it's visible to you that the balance in your bank account is going down and you're not spending any money just because of the negative rates. So that will encourage you to go out and buy anything that you think is going to hold its value better. So, we use they use these crises. We can use them too, but they use this crisis to transfer the wealth because who's going to complain? If they can get you to volunteer, which is what we're seeing in the stock market, right? And the real estate market to some degree, because there are people that are bidding up individuals that are, paying way above current market, which is inflated anyway. But what I see is a huge crisis, then everybody going, help me, help me, help me. And then they agree to whatever they have to agree to survive. So I definitely see UBI coming in, Universal Basic Income, because the whole entire social structure is changing. I mean, it absolutely is. And I think we've already begun that transition to it. But they've built a consumer-driven economy, so the consumers have to consume. I just looked at it again this morning. We have right now a savings rate of about 27, I think it's 27.3%, right? Now, before the Great Recession, it was the lowest that it had been going all the way back to when they started tracking it. Now it's really high because of all of this money, that taxpayer money, I might say, that is being given away. And, necessarily, I mean, they couldn't do what they did in 2008 in 2020 by giving it just to the banks and the upper echelon. So they had to spread that out so people feel like they're getting something.